afternoon, everybody. Hope you're doing well this beautiful day in June. And welcome as we look at the market in lieu of Brexit and whatever else is going on in the world, try to make sense out of this. How many are confused on what the market's doing? Anybody? All right, one honest person here. The rest of you are being unhonest. No. So we're going to talk about the market a little bit, at least how I see it, and then we'll go into a couple trades, right? So maybe let's dig in, what's kind of been going on and stuff, and maybe we'll go after a few things. So we had this event called Brexit, which came out on which day? It came out Friday, right? Then, I mean, it was Thursday night, but it was reflected in all the prices on Friday, right? It affected your option day on Friday. And so where did SPX close Thursday night? In other words, Brexit was going to come out after the close on Thursday, but where did it close at? Okay. So SPX closed at about 21.13, 21.15, whatever the number is. But the point is, how many points on Thursday's close were we off of the all-time high in SPX in the history of civilization? So on Thursday's close with Brexit coming that night, how many points were we off the all-time high in the history of civilization? 25 points, 25 to 30 points. What do I mean? If we closed in the vicinity of 21.15 on Thursday, the all-time high in the history since the Roman Empire was about 21.35 in the SPX. So would everybody agree? I'm just setting up. So Thursday we were near the all-time highs, and then the market. So we're at the all-time highs, but understand, on a typical day, if we're closing 25 points off the all-time high, what would VIX be normally? On Thursday night, if there was no event called Brexit out there, or whatever it's called, where would the VIX be probably? Where would the volatility be if we were 20 points off the all-time high? Probably 12 or 13, right? And where was VIX at the end of the day on Thursday? Does anybody know? So I'm just setting a little bit of the atmosphere. VIX was near 20, right? Where was VIX? I'm just setting up a little environment here. So we're over 20. So what was going on? We were basically, most of you are familiar with the environment of, hey, Netflix is going to have earnings, or Apple's going to have earnings, or Amazon's going to have earnings. You're familiar with what happens there. Volatility pumps up into earnings, right? And then after earnings, what happens to volatility? It all comes out. So this Brexit was one of the only times I've seen in the last few years where really like an earnings event on the market, right? You had this event called Brexit, and the option volatilities went up. And then and then they started to come down. I mean, Friday the volatilities continued up some, right? But the point is, this was like an event on the market, right? And if you really are trying to understand what happened, the best thing you could do is think about Apple earnings, or Amazon earnings, or Netflix earnings, or whatever earnings. They're similar, not totally similar, because usually after earnings, volatility comes out, and after the event, Friday vol was still up, right? So, but a couple things I want to point out. I'll just point, I'm going to use my whiteboard here, just because I don't want to. I mean, bottom line, do I know where the market's going the next 30 or 40 points? Up or down? I don't, and you don't either, right? So I can just say, I'm just kind of how I look at this environment and how I'm kind of trading. That's all I want to talk about today. because I don't know and you don't either, right? So a couple of things I just want to point out of what I think. Let's just say the range. So the range of the market before Brexit for the last 3-4 months in SPX was about 2050 to 2120, right? You know, we dipped under 21 a little bit for 12 hours or 14, but this is basically the range in the SPX. Everybody agree? Everybody agree? That was the range in the SPX for about the last 3 months, excluding Brexit. You know, what do I think the range for the next month or two? You know, again, we went as low as, I think we hit a low of 1990 on Monday, didn't we? And then we started the rally for the last 2 days. So, you know, again, nothing profound here, but, you know, maybe we're in a range of 1990 to 2120, right? So what's the toughest adjustment for me right now, or stuff I'm talking with our community about, is just a little bit of a different range. Do you agree? Just a little bit of a different, we're trying to say, I don't know what's going to happen in Brexit over the next month, but, you know, at least my gut says, would it be, let me ask you a question. Are we England or the United States? I'm not saying we're not affected, but let's put some perspective. Are we England or the United States? Simple question. All right, let's be clear there, right? If this was Brexit US, there'd be a bigger impact. But again, we're not England. Well, Dan, we're affected by England. I get it, but we're not England, right? And I think, you know, I mean, it's England, right? And I'm not saying there won't be some effects. I think they'll work it out. But we're still stinking United States. And again, I think it's, you know, again, this is the range, 1990 to 2120. And VIX today was what? About, last I saw it was 1678. So right now, I think that implied volatilities are about where they should be, right? And I think that's going to be the range. And it's a little different range than we've been used to. You know, the last 3-4 months for range-bound trades have been phenomenal, right? On a $2,000 vehicle, they have a 70-point range. What more would you want on your Christmas shopping list, right? And so, to me, you know, the fact that we've gone up a couple days, right? The fact that we've gone up a couple days, very normal, right? You know, we went screaming down. Now we come back, and now, you know, in this range of 2064, you know, it's a little more difficult at this point, the next 20 or 30 points. But I think from a volatility point of view, let's be clear. For those of you, you know, in our community, quite a few people had on Friday. Let me just make a statement. In our community, the people that I was, you know, having webinars with in the last 3-4 days, and I had one every day, people in our community that had on butterflies, iron condors, short Vega trades. On Friday, with the VIX up tremendously, how should they have done? How should people have done Friday with the market getting killed and option volatility going up? Not so good. Here's the reality. Friday and Monday, with the market going down, Friday the volatility went up, Monday the volatility went down. You know, on the webinars I did those days, let's say there were 60 people on at a time, I knew from my own trading the answer of it, but I wanted to confirm it. And I asked the students, did one of you, not two of you, did one of you 60 lose money on an iron condor or a butterfly on Friday? Not two. Did one of 60 lose money on an iron condor or a butterfly on Monday or Friday? And you know what the answer was? No. Let me say that again in Spanish and a little Norwegian. Did one person, I'm not saying that they came in terribly betting on one direction. I'm talking the normal income trades, basically non-directional, iron condor, butterfly, whatever, not one. As far as the people that we had on, not one. Now, why do you think that is? Why do you think that is? Anybody? Why do you think? We'll address Friday and then Monday. Why do you think that is? No, it doesn't speak about, thank you, Dino, but anybody with a short Vega trade on that was relatively delta neutral, even though the volatility, Monday was easy, right? Monday was, or Tuesday, yesterday, the volatility was one of the, here's your homework. Yesterday, the SPX was up about 30 points and the VIX was down 5. You agree? Yesterday, the SPX was up 5. Excuse me. Yesterday, SPX was up 25. The VIX was down 5. Is that right? Anybody that can show me, right, can go back over the last 6 months or a year and find me a period where the SPX went up about that amount and the VIX went down 5, I'll come over to your house and kiss your left toe. You ready? All right, so anyone who, what's my point? It was very unusual. Volatility was very elevated to start with. It was very, as Tom Jones would say, it was very stinking unusual of what, because it was an earnings event on the market, they destroyed the volatility. If you just want to write this down, well, I'll show you real quick. If you look at a chart of, if you look at Thinkorswim here, I'm just using this for, and look at an SPX price chart, a couple things I want to show you. A couple things I want to show you. If you look back here, let's look at a couple instances. Here is March 10th. I'll just take 2 instances. March 10th, SPX closed at 1989. March 10th, SPX closed at 1989. March 11th, it closed at 2022. How much is an up move of that from 1989 to 2022? How much is an up move of that? And that's coming from lower levels, but that's a 30-point up move. Agree? Are you with me or no? Am I losing you? About 33 points up, right? From March 10th to March 11th. And we came from lower, this is when SPX was lower, right? Near 2,000, similar. But let's look at the VIX. What did the VIX come up? On March 10th, right? On March 10th, VIX it closed at 18, and March 11th, it closed at 16.5, down 1.5. So Dan, explain to me what you just said. SPX up 33 points, VIX down 1.5. Does everybody get that or no? Yes, no? All right. Dan, what are you doing? I'm trying to make sense of the fact that SPX went up, 25, 30 points yesterday, and VIX came down 5. Please don't expect that if you're a short Vega trader. That's thinking Christmas and it's your birthday combined. It doesn't happen. Let me bring another one. If you look at January 19th, right? Last one. I just want a little perspective is okay, isn't it? A little perspective doesn't hurt. January 19th of this year. January 19th, SPX was, so January 19th, can you guys see this price chart? What is this called? All right, what is this called? This move down here in early January. What would you call that? What would you call that move in early January of 2016? Begins with a C. Correction. Correction. 10%. So the market came down from 2075 to 1875, 300 points in about an hour. Took more than an hour, right? But 300 points, the market came down, right, in literally 2 weeks. You with me? Dan, what are you doing? I'm putting a major focus on what happened yesterday, that it was a stinking rarity, right? And it's a rarity because it was an earnings event. So here's a 10% move in the market. We're down 300 points, right? Brexit didn't take us down 300. So let's look, right? Let's look right here with a 300-point move in 2 weeks. What did from Jan 19 to Jan 22? 300 points down. Wouldn't you? And the VIX was up in the was up in the rafters. Let's see what the VIX came down. So let's see what the VIX came down as this thing bounced. Okay, so if we go to January 19, all right, where are we at here? If we go to January 19, VIX was closed at 26, and 2 days later, on the 22nd, right, we went from close of 26, on the 22nd, went to 22.34. So about 370. So let's put this perspective. VIX was down 3.7 points over 2 days, 2 or 3 days, not 1 day. And this was a bounce off the market was down 300. Does everybody just Dan, what are you doing? I'm giving you a little perspective. Are you kind of seeing? So in other words, if you're a short Vega trader and your neighbor's bragging on how much the volatility came down yesterday, yesterday was a stinking freak of nature. You with me? If you're expecting yesterday, you need to get a plane ticket immediately and go to Magic Kingdom and hang out for 2 weeks. So if you really think yesterday, if yesterday you had a vision at night and said, you know what, honey, I should quit my job and I should sell volatility over and over and we're going to be millionaires. Before you do that, go get a plane ticket to Orlando and tell your wife you need to move to Disney World. Agree? And live, get a job at Magic Kingdom, maybe work one of the rides like It's a Small, Small World or Pirates of the Caribbean. You with me? So it was a freak, right? It was an earnings event on the market. The volatility's got ballooned up a lot. You know, short Vega traders, right? I've never seen, you could have thrown anything. Again, I don't know anybody in our community over the last 3 days that lost money on short Vega. You with me? You with me? And it doesn't happen that way because a lot of times when volatility comes down, the price move will offset what you made in the volatility, but this time it was different. So I want to point that out. Now, what's another thing? What's another thing I think you guys got to be aware of, right? What's another thing you got to be aware of? And this is just, I'm trying to get you guys to relax a little bit, right? How many of you have been reading stuff like, or different things like Dino brought it to my attention, the CBOE volatility skew was at the highest level since Cleopatra got married. Anybody read that? Not the Cleopatra part. So the skews are big and a lot of stuff. But here's the problem, all right? Let me give you a bad reality. How do you think websites, right? How do you think trading websites or stock websites, anybody who sells newsletters or education or whatever, how do you think in the world of internet marketing, how do you think they get hits on their site? How do you think they get hits on their site? They get hits on their site by linking with whatever the story of the day. So if everybody is looking, did you know the word Brexit was one of the most Googled words over the last 3-4 days? Did you guys know that? The word Brexit? Did you know that? So So if I wanted to get hits to Sheridan Mentoring, what do you think would be a good idea? If I wanted to get hits to sell newsletters or whatever someone wanted to sell, what would I do? I'd write an article, something to do with Brexit, and agree. But the other thing is put some wild headline, right? Sheridan Brexit trade, or why Brexit could end the world, or a trade to survive Brexit, or how to not let Brexit ruin your marriage, or, right? But again, so what happens is when you guys click on Brexit and you see Dan Sheridan gives a way to save your marriage and profit from Brexit, right? But I get a lot of hits on my site, right? Does that make sense? So what I'm saying is you read like Dino called me today, and Dino's a heck of a trader. He said, Dan, I heard the SKU index at the CBOE is the highest it's been since Tom Jones left England to make his fortune in the U.S., right? And does anybody know what a SKU index is? A SKU index is basically, you know, are people buying lots of out-of-the-money options like puts and stuff? And the answer is, yeah. So SKU index is where you're buying a lot of, you know, do you think if you were a stock fund and you owned a lot of stock or you had risk to the downside, do you think people were buying protection in the volatility indexes over the last week? Yes or no? Of course they were, right? Because they don't have like options traders, there's a lot more choices than somebody who just owns stock as far as the downside. So I think a lot of it's emotion. You know, you look at CNBC or any of those, they're going to have titles. How to profit from Brexit, how to do, and all I'm saying is, you got to be careful, right? It's just, but the event is over, right? I mean, I think the difference with this event is nobody knows what's going to happen with this goofiness. But I think, hey, remember, at least the thing that makes sense to me, we're the U.S., right? And we'll be affected, but it's not us. And right now with the VIX as we speak, what's VIX? SPX is 2068. And we're kind of now in the middle of the range. We had a couple up days, and the VIX is what, under 17 right now? Okay. All I want to say is we're 16.15. The party's over, right? In terms of opportunities from short Vega, right? I believe we should trade short Vega trades all year round, right? All year, whether volatility is high or low. Most of the time we make more money when volatility is low than when it's high, right? The only time volatility is high is in stocks, usually around earnings, or we've had a big down move in the market, and that's about it. So, but in terms of this getting massive help from volatility, suffice to say, if you look at a picture of the graph, if we continue up, the VIX can go down a little more, but suffice to say, you ready? The party's over, right? Let me say that again in Spanish. The party is over, all right? Now, so again, I think the key is to get back to trading. All the nonsense is over for the most part, but we're going to have maybe a little wider range. If you look at the market, folks, if we get an SPX chart up here, and then I'll just go into a few strategies. But if you look at an SPX price chart here, over the last, all the way back towards March, before Brexit, here was the range in SPX. That's brutal, isn't it? Isn't that stinking brutal? No, on a $2,000 vehicle, we're in a 70-point range, right? And just now, I just think is this thing, the tricky thing now is just what's the new range for now, right? Are we going to be in this 21, 25, 2,000, or will we go back down and go a little lower? I don't know, but that's kind of how I'm playing it now. So again, focus on the position, focus on the craft, and on and on. All right, a couple trades I'm looking at right now. Now I'm flipping over towards more calendars. I know that's a lot of you may not be familiar, but I'll talk about some other trades besides calendars, but let's go over a few trades that I'm looking at right now. If you look at SPX, SPX is at 2067, right? And let me just move this here for you. All right, so if we look at this, SPX is at 2067. And if you look at the, I'm just looking at expiration, here's the July 29 expiration, 30 days away. Can everybody see that? Everybody see this? What I'm, yes, no? Okay. Here's the August expiration, August 19 expiration, 50 days out. So if I did an at-the-money calendar, let's say we're at 2066.72, they don't have a strike at the 2066.72. So let's say I did the 2070 calendar. I bought the August 19 expiration 50 days out. I saw the July 29 expiration 30 days out, typical calendar. I buy one basically at the money, the 2070s in August, and I sell one in July. Does everybody get at least what I'm doing? Does everybody get what I'm doing? Yes, no? You understand what strike I'm buying, what expiration I'm buying and selling? Can you see that? Yes. All right, so let's look at the volatilities. The volatility of my long option I'm buying and the calls is about a 13. So I'm buying a 13 volatility. And the one I'm selling, right, is a 13.14. So that's called a positive skew. Dan, what do you mean by the word positive skew? Positive skew in a calendar is where the option volatility of the one I'm selling is higher than the one I'm buying. And generally, when you're talking about 30 to 50-day options, which I'm looking at here, I'm buying a 50-day, selling a 30-day, you don't really get positive skews unless the market has been going down and then volatile, right? Let me say that again. Most of the time, when you're looking at options, right, let's throw a big word out there, contango, right? Whenever I think of contango, I think of the dance, the tango. But what does that mean in English, Spanish, and a little Portuguese? It means that your farther out options are going to be higher than your near-term options, correct? Right? Right? Yes? No? Maybe? So? Okay. Now, do I normally get a positive skew like this? No. Dan, why are you getting a positive skew? Well, it's because the market has been going down and we've been volatile. Usually, the option I'm buying will be higher volatility than the one I'm selling. So it's a little bit unusual. But the bottom line is, I'm buying a low volatility, I'm selling a low. Are 12 and 13, are those low or high volatility numbers in SPX? Are 12 or 13 low or high volatility numbers in SPX? Are 12 and 13 low or high? So not only am I getting a positive skew, but from a volatility point of view, I'm selling the one more expensive volatility than the one I'm buying. They're both low. So from a calendar point of view, do I think it's advantageous to do a calendar? I do. Like David said, low to mid. But it's not bad from volatility point of view. It's not bad, right? But, so with us at, here, let me switch the strikes because we're closer to 2065 now, aren't we? We're closer to 2065 in the market. So if you look at the 2065 calls in the July 29 expiration, 30 days away, and you look at the 2065 calls in the August 19 expiration, 50 days away, again, we're buying a 13, selling a 13 and a half or something like that. So from a volatility perspective, it's in the low end of the range. I like that for a calendar. But can I make a decision just on the volatility to do a calendar? What are the two ways I lose money? What are the two ways I lose money in a calendar? What are the two ways I lose money in a calendar? Price and vol. So from a volatility point of view, do I like the current volatilities for doing calendars? As Sylvester Stallone would say, absolutely. Now, from a price move, it's different, right? From a price move, it's different, right? Dan, what do you mean it's different? You know, I have to look at my projection. Do I think, how many people think if we put a calendar on at the 2065 strike, right? If we put a calendar on at the 2065 strike, so here's the calendar, right? One second here. We're at 2065, right? So here's a calendar at the 2065 strike. All right, so here's your graph at expiration. Usually in a calendar, you want it to be at the short strike. So if we put a calendar on today at the 2065 strike, right, and I sell 10 at the AUG 19, this is all calls. I sell 10 at the AUG 19, or at the AUG 19 expiration, 2065s, and I buy 10 at the, excuse me, I buy, oh, stinker. All right, you guys get it. I'm not going to keep, or it went away, but I'm buying the August. I'm selling the July. My longs are about 50 days from expiration, and my shorts are at, let's say, 30 days from expiration. But if you look at it here, that's my calendar. These are my expiration break-evens. Beyond these points at expiration, I lose money. I'm just giving you a little idea on this trade. So on the downside, let's see, the break-evens are 2020 on the downside, 21, let's say 14 on the upside. Dan, what are you saying? Here's what I'm saying. If our short strike on a calendar is at 2065, and my upside break even at which the expiration graph starts going under zero, on the upside it's about 2114. The downside is around 2020. About how much room do we have on the calendars before the dog leaves the fence, right? How many points? 2065 minus, so on the downside, if we start going down, my break even is 2020. We got about 45 points room on the downside. And again, this is a calendar. And on the upside, about 50 points, right? So all this range is 50. Now, question says, why do I like calendars? We aren't in a low volatility. First of all, I didn't say that I like calendars over anything else. I said volatilities have come down quite a bit, and doing a calendar in SPX in the 12, 13 level is pretty good, I think, and especially in lieu of what's been going on in the last 3-4 days. So from a volatility point of view, I do think it's pretty good because the volatilities are relatively low. The skew is pretty good. But again, you know, you don't make money because the vol's low or high. You make money by managing the trade. And, you know, again, as long as, and let's just say for purposes here, if I'm managing this trade, the cost of this calendar is $8.50. So if I bought 10 calendars, how much capital would I have to, how much risk do I have, and how much capital do I have to put at my brokerage firm? This calendar is going for $8.50 right now, mid prices. If I bought 10 of them, which is this example is buying 10 of the Aug 19 expiration 2065 calls about 50 days out, and selling 10 of the July 29 expiration 2065 calls 30 days out, how much capital? So this is about an $8,500 trade. So on this trade, what am I looking for? Right? If this is about an $8,500 trade, what am I looking for? I'm looking for about 10%, right? What's 10% of 8,500? What's 10% of 8,500? So I'm looking to make somewhere around $800, right? And so let's go out. What I did is I just took the graph and I said, what will we look like in about 2 weeks, right? This would be about 2 weeks, somewhere around here. See what I did. I took us to about July 13th. Is that about 2 weeks? Is July 13th about 2 weeks? Is July 13th about 2 weeks from now? Yes, no? Yes. So this is roughly what the graph would look like in about 2 weeks, right? So in 2 weeks, that's about the graph. And again, my short option is 30 days from expiration. My long is 50. You know, would I have a shot at making 10% in 2 weeks? Absolutely, right? And so that's kind of the game plan. You know, if we start going outside our expiration points, again, I'm just trying to give you a quick risk management just because we don't have as much time, but that's what I'm looking to make on this. You know, in a 30-day trade where my shorts expire in 30 days, I might look to keep it for 20 days. There's not a trade that I wouldn't put on right now. Iron condor, calendar. There's not a trade I wouldn't put on right now. It's just I might tweak it a little bit differently, right? So that's a calendar. If I were to put on a, right now, if I were to put on a, and let me explain to you, let me just do one last thing. Here's the Greeks. Here's the Greeks if I do a calendar right now at the money. Let me just explain why I would do it at the money. So if I do it at the money, I'm long 2 deltas. My gamma is short 1. That's if I do an at the money calendar 10 times. We'll get to another trade next. Matt McAllister is someone I've been emailing with, and he's being paid by the Double Diagonal Company of Kentucky to promote the double diagonal. So he's on they seem best, and he's being paid by the Miller Brewing Company to, so there's no trade right now that's better, right? Right? There's no trade, right? There's no trade that's better. But anyways, so the calendar is neutral deltas, short gamma, positive 123 vega or theta, and my vega is like 677. So when I have a calendar where my short is 30 days from expiration or so, and my long is 50 days to expiration, the biggest Greek in the neighborhood is going to be the vega. Now, normally when I'm doing a calendar, I want to lean more long delta because of this long vega. But with the volatility coming down dramatically, and I'm not as concerned about risk with the volatility now as I was 4 or 5 days ago, I'm starting the calendar, and because we've gone up 2 big days, with us, you know, I'd be starting at the money. In other words, generally when I'm doing a calendar, let me say this, ready? And then something you can look into. So right now, with SPX at 2065, if I'm doing a calendar, listen carefully, if I'm doing a calendar at 2065, right? That's where we're at, 2065 in the SPX. If I'm doing a calendar and I'm selling an option 30 days from expiration, buying an option 50 days from expiration, 90% of the time, if I do that, I'm starting the calendar at 2075 or 2080. Why? Why? Why 90% of the time when I'm doing a longer duration calendar where my shorts are at least 30 days from expiration, why do I consider it normal to start the calendar 15 strikes up bullish? If you ask me what's the single biggest reason in the last 4 years why people who basically we've been in a bull market the last 4 years, why people have struggled with longer duration calendars, it's because they didn't understand the Greeks, period. They didn't understand the Greeks, period. And when you're starting out with a trade that's got enough long vega to kill a horse, a cow, and 3 mules, right? You have to lean your deltas longer, right? So if we're at 2065, I would start my calendar at 2080 and maybe lean 10 deltas or 15 deltas long against that big long vega. Dan, why are you starting a calendar at the money today and not starting it more bullish? Because we've just run up 2 days, the volatility's got destroyed, and right here, right, I'm not as concerned with the volatility on the upside, right? So again, here's the difference between people who trade or do this for a long period of time. In other words, most of the time, if you guys are setting up a position, be honest, especially people who aren't in Sheridan Mentoring, but people who are just watching this, when you're setting up a trade, be honest, how many of you who aren't in Sheridan Mentoring, when you set up a trade, the first thing you're considering is begins with an O, your opinion on which way the market's going. How many of you who aren't in Sheridan Mentoring, when you start a trade, you're starting out with your opinion on which way you think the market's going? Be honest. Right? I know there's more than Kelvin here. All of you, I bet. Right? And all I'm saying is, and I believe this with every ounce of my heart, that the whole problem, why people struggle with, not everything, I mean, there's a lot to it, but one of the biggest problems in the option education and option for people becoming a craftsman, right, is that they're starting out with an opinion on which way you think the market's going. And until, I'm not saying there's not somebody out there that can make some money based on their opinion, but I'm saying for 90% of the population, I think until they take out their opinion and put on kind of non-directional positions, kind of diversify your durations and stuff, so you get around, Dan, how can I put an iron condor on when the SPX is 2120? Well, you don't have to put them all on that day, right? Put some on, maybe put some more on in a week. But the key is, I think that's the biggest single detriment to a consistent living for most people, is the fact that, you think about it. If your neighbor came up to you and said to you, hey, why don't you follow my opinion on the market every couple of weeks for the next year and you'll make a living? Would you believe it? Would you believe it? Would you believe your neighbor if they said to you, hey, follow my opinion on the market? Now, a lot of people think, well, but Dan, I'm putting my opinion, but then I'm putting a high probability credit spread. Now, let's talk about it. So someone says, well, Dan, I'm putting my opinion. I think the market's going to back off, right, from the current levels. We're at 2064, and I think we're going to back off, so I'll do a credit spread at 2080. Now, is that much better? Is that taking a step in the right direction by saying, hey, we're at 2064 in the SPX. I'm going to put a credit spread on at 2080. or 2085. Now, is that a step in the right direction? I think it is. You're combining maybe something out of the money, you're selling a problem, but you're still getting some opinion. And to me, I'd rather put the whole iron condor on. I'm not saying there's never a situation to put a credit spread, but I'm just saying I think the biggest detriment to people's being consistent as a trader is, number one, their stinking opinion. Number two, they don't have a good risk management plan. In other words, you know, they trade like Dorothy from Wizard of Oz. I hope. You know, January they may make $500, February make $500, March make $500, April make $500, and then May lose $4,000, right? And what that is just no risk management. And I think if you could just keep your losses near where your winners are, don't lose too much more than you make, you'll be in good shape. Anyways, Steve says, can you really trust the calendar's break-even numbers using a graph? They will fluctuate. Now, Steve made a good point. Again, we're not getting into, you know, again, we have limited time today. I'm already running out of time, but to go into a whole calendar discussion. But anytime you do a mixed month spread, your break-evens can change as the volatilities change, right? I mean, I think the volatilities right now, I think they're getting a little more, they're not going to change as dramatically as they did the last 3-4 days, but overall, in most market situations, you can roughly trust the calendar's break-even numbers using a graph. Yeah, I think most of the time. But I think over the last 4 days, things were changing wildly. I think right now, with SPX at 2064 and VIX at 17, they're a little more normal. Anyways, you know what I might do? I didn't cover as much as I wanted to. I might do another free webinar in a couple weeks or so. I can't go more than an hour here. I've got something else at 12. But at least I think I'm just trying to get you to think through what the heck's going on, not to panic. And again, focus on your strategies, right? So am I saying today that everyone should go out and do a calendar? No. Am I saying calendars are any better than iron condors or butterflies? No. Am I saying if I had one trade to put on today, I'd put on a calendar? I'm not saying that, right? I just happen to, because I noticed the volatilities are becoming much more favorable, I would consider from a volatility point of view put on a calendar, but I would do an iron condor. We've been doing those the last 3-4 days, and butterflies. I think they're all fine. And part of it is the Greeks, right? So if I did you know, how I would structure an iron condor today, I'll do this real quick. How I would structure an iron condor today, I would probably do something like this. So SPX is at 2064. And I would sell again, I'd be in the AUG 19 expiration about 50 days out. And I would sell the 2170 calls, something like this. I'm just giving you an example. And buy the 2180s. So the 2170 calls would be around a 9 or 10 delta. And again, we're 50 days from expiration and the August expiration. There'd be the August 19 expiration. So sell the 2170s, buy the 2180s. And then in the puts, I would sell the 1860s and buy the 1850s. So the options that I would sell are the 1860 puts and the 2180 calls. Now, there's many different ways to do an iron condor. In this particular example, they're both around a 9 or 10 delta. But what do you notice? Even though they're both 9 or 10 delta, and my upper short would be the 2180s, lower short would be the 1860s. The current price is around 2064, which is right here. So it looks like we have more room on the downside than the upside, even though we're selling our short put, the 1860 put, at a 9 or 10 delta, and we're selling a 2180 call at about the same delta. It's just that for the same delta call, 9 or 10 delta call, we're getting about 200 points out of the money from the current price on the put side. And on the call side, we're getting about 120 points. So right now, a same delta iron condor, I call it conventional. Conventional iron condor would be selling a 10 delta call, 10 delta put, 15 delta call, 15 delta put, 20 delta call, 20 delta put. You're going to get a lot more room on the downside. Everybody with me what I'm doing? Steve says I'm getting 12 delta for the call. Maybe it changed a little since I looked at it. But basically that's how I set it up. We might have changed just a little bit. But that's basically how I set it up, close to that. So you say, why do I set it up like that when the volatility gets just a little bit lower and we've rallied a couple days? I'd want to set it up a little bit. If you look at the Greeks of this trade, position Greeks, and this is 10 contracts. I'm 15 delta short, positive 36 Vega. This is about a 10 grand position, maybe a 9 grand position. I'm short Vega. So I want to lean, especially after the volatility's come out hard and we've rallied 2 or 3 days hard, I want to start my iron condors a little bit short delta against my short Vega. And I do that by setting up a conventional iron condor while I'm selling the short delta of the call and the put are about the same. And I do that after we've had a couple big days up. Now, am I saying that we can't go up from here? No, I don't know any more than you do. But usually after we've rallied some and the vols have got tanked, I want to lean a little bit short delta against my short Vega. Why? Because if we go down, I'd make money on the short delta, but I'd lose on the short Vega. You see that? So again, it's, folks, what I want to encourage you, this is a craft, right? This isn't about headlines and which way the market is going and quick money and show me the money. Until you decide you want to learn the craft and treat this as a business, your P&L is going to be like a yo-yo in a toy store. And so I think it's, what type of iron condor do I want to put on at this point, and then how am I going to manage the risk, and where am I going to take it off, and it's learning it. And anyways, I'm going to run here. Maybe we'll touch base in a couple weeks. One thing I want to point out to you folks, if you go to the front page of Sheridan Mentoring, last week we had our annual 2-day seminar in Chicago. It was great, about 11 speakers, many very, very good craftsmen, and even some people outside the business, but many, or outside our community, but many good craftsmen in our community shared what they're doing, how they're making money, their journey, what they do. And I think it'd be a good encouragement to you. It's 2 full days of seminars, and you beautiful videotaped and everything. You get all the PowerPoints. I think this would be a huge help to you. I think it's like around $400. You get the archive. But if you're interested in that, we just edited it. I think it's wonderful. I think it'll be the best $400 you ever spent in terms of getting practical on how to do this. So I would go look into that. Anyways, have a great day, everybody. We'll see you next time, and become a good craftsman. Thank you. Practice the craft.